Pike County, Ohio. Farmland. Forest. A few small towns. And rising out of it, one of the largest computing facilities ever attempted anywhere on Earth. 8 gigawatts of planned capacity, roughly the output of 8 nuclear reactors. The tenant is OpenAI, the maker of ChatGPT, on a lease that runs for 20 years. But OpenAI is not the company standing behind this deal. Neither is the developer building it. The support, up to $105 billion of it, comes from somewhere else entirely. It comes from Nvidia. The company selling the chips inside is now helping finance the infrastructure that buys them. The most valuable company on Earth is co-signing the rent for one of its most important customers. To understand why, you have to follow the money in a circle. 30 years ago, Nvidia made graphics cards for video games. Today, under founder Jensen, it is the first company in history worth more than $5 trillion. The growth has no precedent at this scale. $27 billion of revenue 3 years ago, then $61 billion, then $130 billion. Last year, $216 billion. Of every dollar of sales, roughly 75 cents is gross profit. 9 of every $10 come from data centers, the giant halls where artificial intelligence is trained and run, and customers wait in line anyway. Which makes what happened this August genuinely strange. Why would a company this profitable need to help finance its own customers at all? For 3 years, the story of artificial intelligence has been a story of shortage. Not enough chips. Whoever could get them, won. But in 2026, the shortage began to move. The problem is no longer only making the chips, it is paying for everything around them. A modern AI campus costs tens of billions of dollars before it earns a single cent. The buildings, the cooling, the power plants beside them. Microsoft, Google, and Amazon can pay for that with cash. But the AI labs themselves and the new cloud companies racing to serve them cannot. They are burning money, not printing it. Which created a situation Nvidia had never faced. More demand than its customers could afford to build for. The bottleneck was no longer silicon. It was capital. So this August, Nvidia did something no chipmaker has ever done at this scale. It went to Wall Street, not to borrow money, to organize it. On August 10th, Nvidia announced partnerships with 6 of the largest investors on Earth: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, KKR. The plan is to mobilize more than $500 billion of other people's money, from pension funds, insurers, and credit funds. To be clear, that money has not been raised yet. These are preliminary agreements, a blueprint for financing platforms to be filled over years. To see what Nvidia is really proposing, think of the mortgage system. A bank does not buy your house. It lends you the money, because a house is an asset it understands, and can value, and can sell if it must. Nvidia wants Wall Street to treat computing power the same way, not as fast-aging electronics, as infrastructure, like power plants, like toll roads, like real estate. Jensen put it in one sentence: We began by building chips. Today, we are helping create a new class of productive, investable infrastructure, AI factories. And Huang added a detail that made investors sit up. Nvidia itself has the option to put its own balance sheet behind up to a quarter of those deals, potentially around $125 billion. Exactly how that support would work has not been disclosed. It will depend on each transaction, but the effect is what matters. When the seller of the machines is willing to share the risk, cautious money, pension money, becomes far easier to convince. A week later, the first giant example arrived. Back to that field in Ohio. The developer is SB Energy, backed by Japan's SoftBank. It builds the campus, and it owns the campus. Nvidia is investing $1.5 billion in the developer itself. OpenAI signs a 20-year lease. It does not buy the data center. It rents it, instead of tying up an enormous amount of its own capital in concrete and steel. But a project this size gets built with borrowed money. And OpenAI, for all its fame, is still a loss-making startup. The financing logic is simple. A 20-year lease is only as strong as the tenant paying it, unless someone stronger stands behind the deal. That someone is Nvidia. Like a wealthy parent co-signing an apartment lease, it guarantees a portion of the lease and power payments. And it promises something more, that the site itself will hold a minimum value. Reuters puts the total possible exposure at up to $105 billion. So why would Nvidia accept that risk? Because of what it gets in return. Nvidia will be the exclusive AI compute provider for the entire site, for the length of the lease. The first phase alone covers more than 4 gigawatts, with an option to double it. 20 years of one campus, filled with nothing but Nvidia systems. So follow the money, step by step. Wall Street funds the construction. SB Energy builds the campus. OpenAI rents it. Nvidia guarantees the rent. And the campus is filled, floor to ceiling, with Nvidia systems. Nvidia is the supplier, the investor, and the guarantor of the same project. Money leaves the system through one door and comes back through another, as chip orders. And Ohio is not an exception, it is a pattern. Nvidia has invested roughly $30 billion in OpenAI, $10 billion in Anthropic, the maker of Claude, $5 billion in a lab called Safe Superintelligence. In total, around $70 billion into its own ecosystem. The companies Nvidia funds are overwhelmingly companies that buy or use Nvidia chips. Critics have a name for the risk this raises: circular financing, a vendor helping to fund its own demand. And the serious version of the question is not whether the demand is fake. It is this: how much of Nvidia's future demand would arrive on the same timetable, at the same scale, without Nvidia helping to unlock the money? It has happened before. In the year 2000, telecom giants like Lucent lent billions to their own customers, so the customers could keep buying their equipment. When those customers failed, the loans and the demand evaporated together. But the comparison is not clean. Lucent's borrowers had weak businesses and vanishing revenue. Today's computing demand is demonstrably enormous, and several of Nvidia's largest end customers have fortress balance sheets. Then again, the whole point of the new financing system is to serve the customers who do not. Huang's defense is blunt. The demand is real, he says, and the capital is not Nvidia revenue. He has even said that the stakes in OpenAI and Anthropic may be Nvidia's last chances to invest in them before they go public. The window for buying shares is closing. The machinery for financing, guaranteeing, and co-signing is just being built. Which leaves the hardest question of all. What is the collateral actually worth? Mortgages work because houses hold value for decades. Aircraft finance works because a 10-year-old plane still flies, and everyone knows how to price it. Chips are different. Industry estimates suggest an AI chip can lose 30 to 40% of its value in its very first year. Not because it wears out, because something better arrives. The lending market already prices that fear. Lenders who take chips as collateral have typically advanced only half to 70% of their value, at reported interest rates reaching into the mid-teens. Those are not the terms of safe infrastructure. Those are the terms of risk. Nvidia's answer is that an AI factory is not a pile of chips. Huang describes long-lived infrastructure that gets upgraded generation after generation, growing more productive each time. But notice who controls that cycle. The pace at which hardware ages is set by Nvidia's own product roadmap, a new generation almost every year. And in Ohio, the party promising that the site will hold a minimum value is Nvidia as well. The company setting the speed of obsolescence is backstopping the value of what becomes obsolete. So what is this really? There are two honest answers, and they are both on the table. The first, this is one of the smartest growth machines ever designed. If computing power becomes a true asset class, trillions of dollars of pension, insurance, and credit money can build Nvidia's world. And Nvidia does not have to own it or pay for it. A major bottleneck on its own growth simply disappears. The second, this is a company reaching into the future to fund its own present. If AI revenues disappoint, the risks stop being separate. Leases, borrowers, collateral values, guarantees, and chip orders would all lean on the same wall at the same time. The difficult truth is that the boundary between organic demand and finance demand is exactly where outsiders have the least visibility. For now, no one can draw that line from the outside. Nvidia became the most valuable company on earth by selling picks and shovels in a gold rush. Now, it has started financing the mines. It is no longer simply supplying the AI boom. It is building the financial architecture that allows the boom to keep expanding. If AI revenues ultimately justify the infrastructure, this may be remembered as one of the smartest flywheels ever built. If they do not, Nvidia may discover that financing your own demand also means sharing the risk when it fails. The evidence will arrive quarter by quarter in Nvidia's own numbers. And this is no longer just Nvidia's story. One company now sits at the center of the chips, the financing, and the build-out of an entire industry. Whichever way it goes, the outcome will not stay inside Silicon Valley. It will reach pension funds, retirement portfolios, and the wider economy itself.